12 ways to make money in the stock market and not to lose. Stick till the end, you'll find some value. Make a plan and stick to it. The individual investor should act consistently as an investor and not as a speculator. Everyone is unique and everyone should have their own goals and plans. The stock market provides us with enough history, lessons, and opportunities to be able to make really solid plans and goals. The thing is, we need to be able to stick to that plan, and failing to plan is planning to fail. So, a plan should include the following. What is my risk tolerance? How many companies do I want to own? Which types of companies will I own? What is my exit plan of the companies that I own? What percentage of my savings will I invest each month? And what are the key metrics when researching a company? And that includes, for example, industry, management, financials, roadmap, ability to execute on plans, the vision of the company, locations of operations, and more. All of these metrics are covered on the FinMeUp app on how to research a company. The second tip is to stay in control of your emotions. The most important quality for an investor is temperament and not intellect, according to Warren Buffett. And I agree. Being able to stay in control of your emotions is extremely difficult for everyone, but it's what can separate you from being a good investor to being a great investor. Not staying in control of your emotions will lead to panic sell, fear, losses, and regrets. Usually people buy high and sell low with bad emotions. Whereas staying in control of your emotions, you know your plan, you stick to that plan, you think long-term, and long-term positive returns will be the result of that. If you are a person that struggles with emotions and especially with finances, why not just invest in an ETF and forget about it? ETFs are a great option for long-term investing. And you can just sit back and relax because you don't have to manage that fund. Look at the history. Be fearful when others are greedy and be greedy when others are fearful. Also a Warren Buffett quote. The 4 most dangerous words in investing are, "This time it's different," from Sir John Templeton. If you look at the all-time stock market chart, you can clearly see that it goes one way, and that is up. The stock market has been through wars, recessions, bubble pops, pandemics, etc. Still, it always goes up over the long term. Not all companies go up, but the stock market. And that's why it is very important to think long term, not short term, because corrections and bear markets is what presents investor with massive opportunities, but also regret. Because usually, back to the second tip, if we don't stay in control of our emotions, we tend to panic sell when we see corrections. It's all part of it. Nothing goes up linearly, but over the long term, it goes up, as history has proven. That is why diversification is key and why finding high quality companies is essential, or ETFs. Learn from others. Everyone makes mistakes. The more we learn from the mistakes of others, the less mistakes you and I will make. The stock market will always find a way to humble us, especially when we become greedy. When you made a mistake, learn from it. When you saw someone else making a mistake, learn from it. Together we should learn, and that is why education is so important. Once again, the FinMeUp app. Tip number 5. Never invest money you can't afford to lose. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. Another famous quote. The thing is, stock market investing is a long-term game. And that is why you should not invest money that you'll need in 6 months or in 1 year from now, because who knows where the stock market will be in 1 year from now. But we know where it will be 10 years from now, higher than it is today. So don't try to speculate and don't invest money you can't afford to lose. Tip number 6. Look at the company and not the share price. Like Jeff Bezos says, I never spend any time thinking about the daily stock price. I don't. The share price always catches up to the company's fundamentals. Look at the company and not the share price, because sometimes it could be overvalued, sometimes it could be undervalued, but it all reflects on how the company is fundamentally performing. So look at the fundamentals and the company itself. Diversification is extremely important because nobody knows what will happen to a specific company or industry in the next year or even 5 years, or where it will be in 30 years. That is why diversification is important. Diversification in geography, for example, the JSE, the US, the ASX, Europe, etc. And then also diversification with companies within an industry. For example, cloud, which has Microsoft, Cloudflare, Amazon, Alphabet, and Google. And that is an example of industry diversification. And then also the various types of industries like cloud, hardware, software, retail, food, agriculture, etc. Number 8, know your time frame. This is simple. Are you a long-term investor or a short-term trader? If it's long-term, what is your time frame? Remember, 6 months, 1 year, 3 months, 8 months, 1.5 years, that is not long-term. Long-term is 4 years, 5 years, 10 years, 20 years plus. And if you're a long-term investor, know what it takes. It takes being in control of your emotions through the volatility on the upside and the downside. Because remember, over the long term, you are going to see corrections, but also rallies. You're going to see the downs and the ups. So stay in control and know your time frame. Then, don't panic buy or panic sell. Time is your friend and impulse is your enemy. Take advantage of compound interest and don't be captivated by the siren song of the market. Another big quote. Panic buying or selling can make you buy high and sell low. That is not what you want to do. Panic sell comes from fear and FUD in the markets or of your favorite companies, and panic buy comes from FOMO, fear of missing out. For example, if you feel you're missing an opportunity because everyone is talking about it and everyone is buying, the share price is going up, and then you just think you're going to miss this opportunity. And then usually that is when you buy high, and then after all the hype, the share price falls and you end up being in regret. Remember, there will always be opportunities in the market, so don't rush in anything and always understand what you are investing in. Tip 10 is more of a strategy, and it is called dollar cost averaging. Personally, if I'm convinced about a company over the long term, then I will buy continuously and consistently, especially as it drops. Why? Because then I can get it cheaper and also lower my average purchase price. Volatility gives opportunity. Note that not every falling knife is one you want to catch. I only ever buy falling knives if I truly believe in the long-term investment thesis for the specific company and I still believe in the fundamentals for the long term. Never invest money that you can't afford to lose once again. Low can always go lower, cheap can always go cheaper. So, dollar cost averaging is appropriate for those companies whose fundamentals are still remaining intact for your personal plan and your personal opinion. There is power in compound interest. Compound interest is the eighth wonder of the world. And if you've seen it, you'll know what I mean by this. To see the true miracles of compound interest, you need to be able to invest over a long period of time. Remember, if you want one of your companies to be a 10x or a 20x return, you need to be able to hold it through various corrections, bear markets, and even when it is 3x up. Why would you sell if something is still fundamentally intact? Because to see compound interest, you need to be in it for the long term, and compound interest is beautiful. It is the eighth wonder of the world. And the final tip is you can do this. You don't need to be a rocket scientist. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ. Also a Warren Buffett quote. There will always be more tips and lessons. Never stop trying, never stop learning. You got this. The most important factor is that you need to start somewhere. Just start, learn every day, grow every day. The FinMeUp app is there to guide you in this process. Have a wonderful day. Remember these tips and share it with a friend who needs to hear it. Have a great day. Cheers.